the block revision, the workbook that we had, and we did several questions. I think 3 questions yesterday. So today we start with the cash flow. Yeah, so that we can see where we shall be able to reach today. We first cover this question of cash flow. Question of cash flow. Cash flow, and the question reads for the cash flow. The consolidated income statement of Uongozi Limited for the year ended 30 September 2013, together with the comparative consolidated statement of financial position as at 30 September 2013 and 2012 are shown below. We've been given the consolidated statement of profit or loss and consolidated statement of financial position there. Additional, number 1, the cost of sales include depreciation on PPE amounting to 640 and a loss on sale of plant of 100 million. Then intangible assets are stated at the book value and comprises of, we have goodwill and others. And they are told other intangible assets acquired during the year ended 30 September amounted to 1,000. Then the cost of intangible asset is included in the above analysis. Then the other one, during the year ended 30 September 2013, the holding company acquired a new plant which cost 500 million. The company also revalued its building by 400 million. Then on 1st October 2012, the holding company made a bonus issue of 1 share for every 10 shares held. The issue was financed from the revaluation reserve. The detailed analysis of the retained profit as of 30th September 2013 and 2012 were as follows. So I've been given the 2013 and the 2012, the balance brought forward, profit for the year, then transfer from revaluation reserve, dividend declared and paid, and you have the balance carried forward. So you are required group statement of cash flow for the year ended 30 September 2013 in conformity with International Accounting Standard number 7, statement of cash flow. So that is our question for Uongozi. So they are calling it consolidated because of the aspect of the associate. Yeah, we had an aspect of associate, we have parent, and we have the aspect of the non-controlling interest. That's why it is a consolidated cash flow. I will do it under this point. Yeah, let me do it here. So this is Uongozi Limited. Uongozi Limited statement of cash flow. Statement of cash flow for the year ended. 30th September 2013. Yeah, so that is our period that we are preparing our cash flow, and I will do some workings on this end. If I need workings, I'll do them on this end. My workings. Yeah, my workings. So that end I will do my workings. Yeah, that way. And remember we said the statement of cash flow is divided into 3 parts. So we start with operating activities. And under operating activities, we said we start with cash flow before tax. We start with cash flow before tax. So profit before tax, sorry. So profit before tax, yeah, we had it there. So this point. So profit before tax, and they are shillings in million, the values that you are dealing with. Shillings in million. Yeah, that way. So we had our profit before tax, which was 1740. And we do the adjustment, necessary adjustment. When you look at the statement of profit or loss, for profit before tax, we had finance cost, operating, so group share over associate profit. This one we shall not adjust because it is after. It doesn't have any effect on profit before tax, but if it was included before the gross or after the gross profit, then you're supposed to adjust because it's another income. But in our case, it is after the profit before tax, so we shall not deal with that. We only deal with the finance, only finance costs there. We shall have our finance cost. And our finance cost, we add it back. Remember, it was a negative. Here we had deducted the 60. So we shall add it back. We shall add it back. That way, 60. Note 1, when you look at note number 1, the cost of sales include depreciation on PPE amounting to 640. We said depreciation is non-cash, so we add it back. Depreciation on PPE over 640, dip on PPE, and still in note 1 where we had a loss on sale of plant of 100. Yeah, loss on sale of plant, loss on disposal of plant of 100, loss on disposal of plant of 100. Then the other thing that we had apart from that in note number 1, we have been given note number 2 where we had intangible assets. And we look at note number 2, intangible asset are stated at book value and comprises of, so we had goodwill. 2012 was 400, 2013 was 360. Other intangible, we had 200 and 940, and that's why we are told other intangible asset acquired during the year amounted to 1,000, and the cost of the intangible asset is included in the above analysis. So when you look at the goodwill we had an impairment because it reduced in value from 400 to 360. 400 to 360. Impairment of goodwill. 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 So for the goodwill, so we shall take here our value reduced. So 400 minus the 360. So goodwill was impaired by that value. Let me just adjust this so that the alignment is on one side. Then after that, we have impairment. When you look at the other intangible, at the beginning we had 2, at the end we had 940. But remember, we are told we had acquired another 1,000. Here we had acquired 1,000, meaning it will be 1,000 plus 200. We are supposed to have 1,200 if there was no any impairment. But in our case, again, we had impairment. It lost value. Impairment of other intangible. Intangible asset. Impairment of other intangible asset of other. Yeah, here we have an R, other intangible asset. So when you look at other intangible asset, other intangible, we are saying we are starting with this, and we had 1,000. What we acquired, and we minus the closing. We started 200, we acquired 1,000, and we closed with 940. So it means we had an impairment of 260, an impairment of 260 for other intangible asset, And I think that was all that we had as far as our profit before tax is concerned. So the depreciation, you have dealt with it. I think that's all, unless there will be any other item that we shall deal with. We shall have the cash flow before working capital. Yeah, cash flow before working capital. Working capital. And here we shall get this total. Okay, so that one is just a minute. Is interfering. Yeah, you're supposed to have it there. So alt equals. Okay, so hoping it will not have an effect on that. Yeah, I think it has picked that. So that total, all of them were to be added. There was nothing. Again, we did not have any gain. So all of them, we are adding them. So that here, I'll pick this and I'll add this. Yeah, the two of them that way. I don't know why it is behaving that way. Okay. So that is our cash flow. We go to working capital. Adjustment, working capital adjustment. Remember, under the working capital adjustment, we said we are looking at the current asset and the current liability. So current asset and current liability, that is what we are dealing with. And in this case, we just need to have the movement in the current asset and current liability. We have inventory and the receivable, and then we shall consider what? The payable. Here, accounts payable. Yeah, that way. So those are the three items that we shall be looking at: the inventory, the receivable, and accounts payable. And for the inventory, when we look at the movement of inventory, we started with 18 and we closed with 28. So it was an increase. And we know increase in inventory is an outflow. That way. The two of them, we just drag for the inventory and the receivable because the argument is the same. Yeah, they have the same argument. So if they increase, we are having an outflow. For the payable at the beginning we had 1460 and at the end we had 17. When payable increases, is an outflow. So we do it the opposite side. Opposite. We start with the closing minus the opening. Closing minus opening, because increase in payable or increase in liability is an inflow to us. And they are the only three items that we have there, and we get this total. That way. So get the cash flow before. Cash flow before tax. So cash flow before tax. Cash flow before tax. Cash flow before tax. And here we just need the sum of the two of them, that way. So that's our cash flow before tax. Then we find the tax that was paid. So we look at the movement. So under current liability, we had the current tax here, and under here we had the deferred. the deferred tax. Yeah, so for the avoidance of doubt, let me open that so that you can easily follow our tax account, of which you can do without this. Our tax account. It's a liability account. So we have brought down. So brought down there are two. We have the deferred tax and the current tax. And the carry down, deferred tax and current tax. Deferred tax and current tax. So for the opening, you'll find that we had a deferred tax here of 280, and we had a current tax of 320. The closing, we had deferred tax of 620, and we had a current tax of 260. Current tax of 260. So those are the opening. This side we normally include what we call for the year. For the year, and for the year we normally find it in the income statement, the income tax for the year. Yeah, this one, income tax expense for that particular year. I'll put a negative to convert it to positive. Remember, it's an expense, so we shall put it as a positive value, and we get the total in order to determine how much we paid. So paid, the difference is what we paid. Yeah, that way. So it means the amount that we paid was 260, which is our balancing figure. The 260, our balancing figure. That is what we paid as our tax for that particular period. We shall have a tax of 260. We get our net cash flow. Net cash flow from operating activities. Net cash flow from operating activities. Just need a sum of this. Yeah, that way. That is the first part for operating activities, and we have gotten our net cash flow from that particular place. Then we look at the investing activities before we look at financing. Investing activities. And remember, for investing is where we are looking at acquisition and the disposal. Acquisition of assets and disposal of assets. And in our case, we were told in note number 1 that we had sold an item of land at 100 at a loss of 100. So we need to know how much did we actually receive. Yeah, how much did we receive from that particular plant? How much did we receive from PPE as disposal? So in this case, we shall open a PPE account with one goal of determining the amount that was disposed, because we'll find that for the PPE, they had given us everything. We were given the net book value, not the net book value. We were given the disposal. We were told in note number 3 that during the year, the holding company acquired new plant for 500. The company also revalued its building by 400. So we were given everything. So if we have been given acquisition of PPE, the only thing that we shall find is the disposal. This is an asset. So the opening will be on the debit, whereby our PPE 2012 we had 36. And you can do without using this. You can do the conventional, the columnar way. Whereby you don't need to open an account, or even you can use a cell, but you have a lot of entries here. So opening was 36, closing was 37.8. So this was our opening, this was our closing. And remember, these are not at cost. Yeah, because they are the values that we are picking from the statement. They are not at cost. If they are not at cost, they are at net book value. And when you are dealing with them at net book value, you shall include depreciation on the credit. And our depreciation was 640. And this one that we had here, 640. On the debit, we acquired cash. We had some acquisition of 500 in note number 3. During the year, we acquired a new plant at a cost of 500. And we had revaluation of 400. Here, revaluation. I had revaluation of 400, and I think that was all. So that the balancing figure will be the disposal of plant. The plant that we sold will be our balancing figure here. So 45. So we shall have to minus 45 minus 37 minus 640. And we'll find that the plant that we sold had a net book value of 140. The plant that we sold had a net book value of 140. And we sold it at a loss. Net book value of that, but we sold it at a loss of what? Loss of 100. Meaning that if we sold it at a loss of 100, we sold it at a value below the net book value, and the amount that we received from this sale will only be 40. So disposal proceeds here. Disposal proceeds from plant. So I will take here 140, and I'll minus the loss of 100. So the profit that we received was 40 because we sold it at a loss. Net book value was 140, but we sold it at a loss of 100. So the amount that we received as cash was 40. And we have been told we acquired. So the rest can be, so before acquisition, we can first consider the associate. Investment in associate at the beginning was 160, at the end was 190. Yeah, 190. But when you look at the income statement, the associate reported a profit after tax of 40, meaning that because of the profit, when we add the profit here, it's supposed to be 200, but we ended up with what? With 190. So the difference we normally say is the dividend that we received from the associate because we have invested in them. We have invested in associate. Dividend from associate. Dividend from associate. So the dividend from associate, which will be an income, we are saying we are taking the opening balance. We add the profit for the year, the amount that they received, the group share of associate profit. It will increase our amount, but later on we minus what we closed with. We closed with 190, meaning that there's some dividend that we received from the associate company amounting to 10. We had some dividend amounting to 10 from the associate. Apart from the dividend that we received, we had now the acquisition of PPE here. Acquisition of PPE. So PPE, we acquired it worth 500, so negative. And we had acquisition, the other acquisition for intangible. The acquisition for intangible. So acquisition of intangible asset. The intangible asset, we acquired intangible asset valued at 1,000. And remember the one that we had it here, this one, the 1,000 for other intangible asset acquired during the year. So we paid 1,000 to acquire the other intangible asset. And when you look at the PPE, intangible and investment, we have exhausted the non-current asset, meaning that's all that we received under the investing activity. Our net cash flow net cash flow from investing activities. Here we get the total of this. Yeah, so it's a total of a negative 1450 as our cash flow from that investing activity. Then the third category is financing activities. Financing activities. And the first one, we look at the shares. What happened to our shares? Ordinary shares. Here, for the ordinary shares, there was a change from 1,000 to 15, 1,000 to 15. But there was a statement where we are told on 1st of October 2012, the holding company made a bonus issue of 1 for every 10 shares held. 1 for every 10 shares held. The issue was financed from revaluation reserve. Meaning that if we are to open these, if I was to open just the ordinary shares alone, just ordinary shares account, you'll find that it's a financed by item. So brought down will be on the credit, which we had 1,000. Brought down was 1,000, and our carry down, was 15. 15. This one that we have here, the 15. Then here the bonus issue. Remember, bonus issue is normally capitalizing the reserve, and the reserve that we capitalized in this case was the revaluation reserve, and we gave them, normally it is issued at par, value. So we gave them a bonus, 1 for every 10 shares held. 1 for every 10. So the shares that we had at the beginning was 1,000. 1 for every 10. 1,000, 1 for every 10. It means our bonus was valued at 100. The bonus was valued at 100, or they were equivalent of 100 million. 100 million, because you'll find that these shares, they were 10 shillings each. So the other alternative is you take, divide by 10 to get 100 shares, 1 over 10, then you multiply by 10 again. That's why, because the par value, they issued at par value, you just take the proportion of that value to be your bonus issue. And the difference is what we received. Difference is what we received. What we received the cash, yes.
And under the analysis of there is what to say that the bonus was excised from the revaluation reserve.
Yes.
And under it, we have seen that the revaluation reserve is 20 million. Now, does it mean it didn't fully fund? Was it not fully funded from the revaluation, or just a part, just a little bit of it?
Okay, it was fully funded, because this was a transfer. This is not the revaluation. Revaluation should be here. The revaluation 10% here. Here is where we have the revaluation of 280. Remember, at the beginning we did not have anything. So let me just give you a summary of the revaluation so that you can see what happened in this case. So the revaluation, okay, thank you for your question. So revaluation here, our revaluation reserve. So for the revaluation reserve, it's brought down. We did not have something, it was a dash, but carried down we had a value of 280. Here, this one was a value that was carried down from the revaluation reserve. But remember, under the PP we had revaluation. So we revalued PP during the year for a value of 400, the double entry. So shall credit the revaluation reserve of 400. Then out of the total revaluation that we received, we have had the bonus issue. Yeah, part of it was financed. It was not part, the whole amount of 100 was financed from the revaluation, and the other one was transferred to retained profit. Yeah, the retained profit is the 20 that we have seen. This 20. Yeah, the 20 was transferred to retained profit. That's why they're saying transfer from the revaluation. Yeah, so the 20 was transferred to retained profit, and you'll find that this retained revaluation should add up. Both sides should add up. That's how it was adding up, because the 20 that was remaining, it was transferred. The 20 was remaining was transferred. So the revaluation or the bonus was fully financed from the revaluation reserve, fully financed from the revaluation. That's
Mwalimu,
how it, yes.
and what in case it is not balanced, this revaluation, how do we treat it? Do we in the cash flow
Okay.
statement in case balanced?
In case the revaluation does not balance, so most of the time, if we are having a balance in the revaluation, and most of the time you'll find that the debit will be less, even if they have not said that they transferred the amount. That is the only option. The amount was transferred. The decrease in valuation is because of the amount was realized and it was transferred to the retained. Mostly as a result of disposal, assuming we had an asset that we had revalued. So by the time we are disposing, ideally, that revaluation is supposed to be now realized and transferred now as part of dividend or part of the retained profit. So if you have a balance, and they have not said whether they transferred, you will transfer that amount to the retained profit. Yeah, so that's how it's supposed to be. You'll transfer it. Even if there's a decrease in revaluation, you don't need even to open. When you just observe there's a decrease and there was a revaluation that occurred in the course of the year, the only cause of the difference is because of the item that was transferred, or some funds were transferred from the revaluation to the retained profit. Okay. So back to the ordinary. So we were looking at the balancing figure here. So our balancing will be 15. We minus the 1,000 that we had and the bonus. So we issued some shares valued at 400. So ordinary shares. So issue of shares. Or you can just write ordinary. There's no problem with that. So from the ordinary shares, and share premium. Okay, we had share premium. So ordinary we are getting 400 that we received, and for the premium, premium we had the difference between the two here. So premium increased from 200 to 700. So we minus the two, and we'll find that from the share premium we had 500. And there is no problem of, again, there are those that will like to combine the ordinary, whereby you normally say you cannot issue premium alone. So it's a combination of the two. That's why here I'm just separating from the issue. There's proportion that went to the ordinary and the proportion that went to the share premium, because there's no way you can raise premium alone. Premium is raised together with the par value at the same time, the ordinary shares. Then we look at the dividend. The dividend paid, and for the dividend, because we are dealing with consolidated dividend paid, we shall again separate. We calculate the dividend that was paid by the holding company, and the dividend that was paid by the NCI, the non-controlling dividend that was paid by the holding, and the dividend that was paid by the NCI. Remember, for the holding, we had some dividend payable here, So during the beginning of the year, we had 400, and at the end of the year, we had 560. But we had this proportion in note number 5, the dividend declared and paid. So we declared 800 during the year. This is what was declared. The previous one, I believe it was paid. But for this particular year, the one that was declared was 800. So you can either decide to open that account, or you decide to do directly in the cell dividend payable. Where we are starting with the end, we need to get a negative. We start with 560 minus, at the beginning we had 400, and we had this one for the year 800. Remember, when I add, it will deduct. So I need to have a positive, so I will minus this, so that when I minus, it will be 8 plus 4, which will be 1200. 560 minus 1200, I'm going to get a figure which will be 640. Yeah, negative, meaning that the dividend that we paid is 640, but still you can open. Draw down will be on the credit, and carry down on the debit. The one for the year on the credit, so that the balancing figure will be on the debit. Balancing figure will be on the debit side. Yeah, that way. Then the other part, the NCI. So the NCI, so let us confirm something. This one, that the dividend that was declared, okay, that one is okay because this was a profit. Yeah, the profit for the year, the 1160, is what was attributable to the holding. This one, attributable to the parent. Yeah, the proportion of the parent is what was taken care of in that particular place. So for the NCI, the non-controlling interest, we need to know how much they paid as their dividend, and non-controlling interest here, they are under this particular portion, and the last part under equity and controlling. At the beginning we had 200, and at the end we had 270. 200 to 70, but remember they had their share of profit here, share of profit non-controlling, where they had 80 at the beginning. So to get the amount that they paid, and already an equal sign, I'll take the figure at the end, 270, and I minus the figure at the beginning plus their profit, their share of profit in the income statement. Their share of profit in the income statement. So the figure at the end minus, the reason I'm starting with the end, so that I just get a negative sign, a negative sign of 10. So NCI, they did pay the dividend of 10 million. They paid a dividend of 10 million that way. Then the other thing was a finance. I think we had finance cost. Finance cost. The others we have dealt with them. Yeah, under the, yeah, we had bank loan before even finance cost. Yeah, so we had debentures first. And look at the debenture and bank loan. Debentures and bank loan. Here, 10% debenture is one, and the bank loan. Yeah, the two of them. Just need to observe what really happened. And look at the debentures. At the beginning we had 200, and at the end we had 600. It means we issued more debentures. We issued more debentures. Remember, debentures are a source of capital because we are raising money. So when they increase is an inflow, when they decrease is an outflow. So we start with the closing, we minus the opening, closing minus opening, and the same will apply to the bank. So the bank, we started with 600, we closed with 520. It means we had some repayment of 80. So you just drag this because already they are the same thing, and you'll get a negative 80. So debentures we acquired, or we issued debentures valued at 400, and for the bank loan of 80, that we repaid. Then we are done with the non-current liability. Remember, the retained, we have not dealt with it because already we had an analysis in note number 5 that captured that. So we are done with this. Under the current, bank overdraft will be our balancing figures. Yeah, accounts payable. So we have accrued interest, and we said accrued interest most of the time goes, accrued loan interest goes hand in hand with what? The finance cost. Yeah, it goes hand in hand with the finance cost. So that here shall deal with finance cost. Yeah, the finance cost. We just need to know how much we paid for the finance cost. So at the beginning we had a 10, At the end, we had a 30, but during the year, remember, we had a finance cost of 60. During the year, we had a finance cost of 60. So we take the 30 minus. At the beginning, we had a 10. Let me pick this one that was a positive. Yeah, this finance cost that was a positive 60. A positive 60. That way. So there's a figure there that has not been captured. Yeah, I'll answer that question. So here we had 30, then this one plus this 60 that we had here, the 60. That way we'll find that finance cost was a negative because it was a repayment. So let me check the figure for debenture. So debenture, yeah, double click debenture. I think debenture is okay because the debenture we had 600 and
Mwalimu,
yes.
it is okay debenture, but I needed your clarification on
Mm-hmm.
two concepts. One,
Mm-hmm.
the under investing activities, kindly cover again. We understand on the dividends we received from the associates. Secondly,
Mm-hmm.
also under the financing activities, you cover under the dividend payout for the parent and the associate kindly.
Okay, thank you. So for okay, let me start with this under the financing, where we are having the dividend, the holding, and the NCI, holding and NCI. So ideally, in this case, you'll find that for the dividend, note number 5, we have been given the dividend declared and paid for 2012 and 2013, 800 and 600, but we are only interested with the 2013, the one that was declared in this particular year. Yeah, the one that was declared in this particular year, because this one is analysis of visa. It was an analysis of this retained profit. Why at the beginning we had 2760 and at the end we had 3140. We started with 2760. We got the profit for the year. We got a transfer of 20 and we declared a dividend of 800. That's why we are closing with 3140. And again, apart from that, when you look at the current liability, we had the dividend payable. Yeah, dividend payable. So this one is one that will guide us now. That at the beginning we had a payable dividend that was supposed to pay of 400, at the end 560, but during the year there was that which we declared of 800. Remember, declaration is not paid, just by declaration. Yeah, so the word paid, it will mean for 2012, because that one we are not dealing with it. It means that one was already paid, but for this particular year 800 was declared. It means the total liability that you are supposed to pay is at the beginning 400 plus 800, which will give us 12, but we closed with 560, meaning a portion of that total dividend was paid. And that's why now we have gotten the 640 being 560 minus 1200, the reverse, so that we got a negative of 640. When you go to non-controlling interest, again they are only
Mwalimu,
supposed to tally. Yes.
excuse, why are we not combining finance cost and loan repayment?
Okay,
Or
so
the
why
other
are
one
we
is the interest? Okay.
yeah, the other one is the interest. So remember, in this case, each one has got a different account. Yeah, so finance cost, we had finance cost up there where we had finance cost. So remember, finance cost is the interest in short. Those are two synonymous names. When you talk about finance cost, it incorporates the interest. So when you look at the current liability, we had accrued loan interest, meaning loan interest still is the interest that we are paying. So we had accrued of 10, and at the end, we had 30. So you can say that it is an increase, but it's not an increase because accrued at the beginning was 10, but during the year, we had another finance cost of 60 that we are supposed to pay. 60 that we are supposed to pay. So that means 60 and 10 in total, we are supposed to pay 70. What was accrued and for the current year. But in this case, now we are closing the year with 30, meaning that the only amount that we paid for the finance cost during that period is 40, letting the one that we got here as a 40. Yeah, as a 40. Hoping that was the question. Yeah, that was the question. The Benja figure that tumeangalia. So finance cost, is it operating or financing? Huh?
I'm
Yeah.
doing good. Welcome to the area. Mkono ulipotelea wapi? Sisi tupo tu. Umekuwa
Okay, okay, so for so there's this question before I come back to that. So finance cost, is it operating or financing activity? So both
Maybe
ways are normally
I can answer Jimmy. Finance cost, we are subtracting it from the operating activities because it doesn't deal with, for example, it doesn't deal with assets either. But again, we add it back under financing.
Yeah.
So it's subtracting it from the operating activity, then we add it back. That 60 is we need to add it back where it belongs. It doesn't belong to operating, it belongs to financing. And that is why we have to look at other activities apart from the finance cost given. Do we have any other finance expenses? That's why we need also to add the accrued bank interest. Then we sum all the finance cost.
Okay. Yeah, so thank you for that analysis. Yeah, so ideally when you look at when we are dealing even with either cash flow, or we are dealing with mostly when we are presenting our incomes, we normally have what we call the operating income. And operating income excludes the finance cost, the interest. Even when you can remember in FM, when we are covering the what, I remember that. Yeah, so when you talk about the earnings before interest and tax, that one is the operating income because finance cost is not part of operating activities. That's why we are adding it back because it was deducted, and the correct part is supposed to be under the financing activity. That is the correct part that's supposed to be shown under. I believe all the other questions I have. Okay, so there was this issue of the dividend from associate. So remember, associate is a company that already we have invested. And one key thing after making an investment in associate, what we shall be receiving in return, apart from the share of profit, when associate will be declaring the dividends that will be paid, we shall be receiving part of it because we are owners of that particular company. Whether we are owning 40%, whether we are owning 20%, if they declare 100 million as dividend and we are owning 40%, 40% of the dividend will be our own. That's why we are putting it as an income under the investing activity. And that one, we have looked at the movement in investment in associate. At the beginning, we had 160, and at the end, we are having 190. And at the end, you are finding that in the income statement, we had received some share of profit of 40, meaning that we are expecting our value to be 160 plus 40 for the entire associate to be 200. But because now we are ending with 190, it means the associate paid a dividend. The decrease is because of payment of dividend, and that dividend we still received because it was an income to us that was paid from the associate company. I think that's all before we go to the cash and cash equivalent. So all the other items we have already captured them. Just get the total for this one, this total, and here we shall have the net cash flow, net cash flow from financing activities, that way, and we get the cash flow for the period. Cash flow for the period or for the year. Cash flow for the year. So our cash flow for the year, we shall combine the three of them. The three. So we had 1290, 1450, and 530. Which will give us 370 as our cash flow for that particular period. Cash flow for the period, which is 370. Then we have opening and closing. So opening cash.
Mwalimu, you forgot to talk about the NCI dividend. You just talked about the holding company.
Okay, so I'll talk about that. Opening cash and cash equivalent, and closing cash and cash equivalent. Closing cash and cash equivalent. Okay, so when you look at the non-controlling, again, non-controlling interest, remember these are the minority. They are the minority shareholders. And normally they will be presented under the equity. You can remember when we are dealing with the consolidation, that's where we normally present them here. So at the beginning, they had 200 as their value. At the end, they are having 270. But the increase in value so that they get to 70 is because during the year, they received part of the profit. Remember, the profit for the company for the entire period was 1240. But this 1240 is divided at parent having 1160 and NCI having 80. You can close this so that it is not misleading. Yeah, so this one, out of the 1240, parent took 1160, NCI took 80. So these 80 we shall add with the figure that we had at the beginning, so that we get there. We are expecting them to close the year with 280 because of the income that they received, part of the profit. But because now they are closing with 270, again, there's a distribution of dividend. To those particular investors. So their value is reducing because of the distribution of dividend. So the difference is what we are calling the dividend that they paid. Yeah, for the associates we received, but for the NCI and the holding, they are paying out. They are paying out money as dividend. That's why we are having it under the financing activity. So the opening and the closing. So for the opening and closing, we consider the cash that we had under the current asset. When you look at the cash, we have cash at the end. 2013 140, 2012 was a dash, and I think we saw the overdraft, bank overdraft. At the end is a dash, but at the beginning we have 230. We don't have any short-term investment, so they are the only two: the cash at the end and the overdraft at the beginning. So the beginning, therefore, we shall put an overdraft. Overdraft, remember, is a negative. So negative, there is one, and at the end is a positive 140 at the end, positive 140 that way. And you can say that when we reconcile that, I believe it is reconciling. There is 70, you add this and you'll get the 140. So that's how that question was supposed to be done, covering the group aspect just as a little bit, because is only that it is consolidated having the associator, but generally the way we approach it is almost the same thing, apart from now the NCI share that has been introduced, the NCI dividend, and the share that we are receiving from the associate. Those are the only two items that are having the difference. The other thing I will point out is, I think I had pointed out when we were starting, the treatment of this value. The group share of associate profit after tax. If this value, they just talk about the group share, associate share of profit, and they include it under gross profit immediately after gross profit, then we shall have to adjust, because again it will be a positive. It is part of the investing, not part of the operating. So we are supposed to deduct it here, and now we account for the dividend that we received under the investing activity. So it will now depend on the placement. So in this case, it was placed after tax, and that's why we did not adjust under the operating, but we have only accounted for it under the investing activity. So that's all under that. So we need to move on to the next, just 3 minutes. Yeah, 3 minutes, then we continue. Any question
Malim,
after that? Yes.
just not a question. Sometime
Uh-huh.
having those those digital on investing activity, financing activity to have the correct answer sometimes is a problem.
Mm-hmm.
So there's a way one can just get these 3 marks
Mm-hmm.
after you have calculated operating, investing, and financing.
Mm-hmm.
So here on opening, closing, cash and cash equivalent.
Mm-hmm.
I think it's always better you start from the downward by
Mm-hmm. You start
starting.
from this one.
Yeah, start from that one because it
Uh-huh.
is provided. You get that one can get that 1 mark there.
Yeah,
Then you
and this
get
one.
operating cash and cash. So
Mm-hmm.
that even if and you can also get that 370 because it will just be you do the calculation of 230 plus 140 to get that
Okay.
370. You see, if you start
Okay.
from top, sometimes it's very difficult for you to get this 370.
Okay.
Oh, dear, that is a very
Yeah, the 370 will be wrong, huh?
the 370 will be wrong. So if you start
Yeah,
it
it
from
will be
downward,
wrong.
you can get it right. So those will be 3 months pay.
So it will not be three. The only one that will get the opening and the closing. Huh? Because remember, the 370, we don't account for it from bottom. It's not bottom up. Huh? Because the examiner will have to prove that actually when you add the 3 of them, you are getting the 370. He knows that when you take this and this, you're